Have you ever pondered the most effective way to invest? This intriguing query has crossed many minds, and answering it correctly is vital for securing our financial future. The world of investing doesn't cater to a one-size-fits-all strategy. That's why it's pivotal to craft a well-thought-out plan that fits your unique financial goals and risk tolerance. In this video, we'll examine two prominent investment approaches. The first centers around a lower-risk, long-term strategy that stresses the importance of building a diversified portfolio. This approach includes avenues like index funds, blue-chip stocks, bonds, real estate investment trusts, and stocks. On the other hand, we'll explore a higher-risk, short-term strategy that targets quick returns. This includes ventures like cryptocurrencies, individual growth stocks, options trading, short-term trading strategies, and initial coin offerings or pre-IPO investments. So, strap in and prepare for a rich, informative journey into the world of investing. Stay tuned to learn how to put your money to work in a way that aligns with your financial goals and risk tolerance. Let's commence with a lower-risk, longer-term investment strategy. Kicking off, we delve into index funds. These are funds that track a specific market index, like the S&P 500 or the Nasdaq Composite. The attraction of index funds lies in allowing you to invest in a broad range of companies, diversifying your risk across the market. Rather than betting on a single contender, you're wagering on the entire competition. Over time, index funds have consistently shown steady growth, positioning them as a solid option for long-term investors. You might consider assigning a substantial part, around 40%, to these broad market index funds. Following, we introduce blue-chip stocks. These represent shares in large, well-established, and financially healthy companies with a track record of reliable performance. Examples include companies like Microsoft, Johnson & Johnson, or Procter & Gamble. These firms frequently pay dividends, granting you a steady income stream besides any capital appreciation. For your portfolio, you might allocate approximately 20% to a selection of blue-chip stocks. We now explore bonds. Bonds symbolize loans you give to governments or corporations. In return, they pledge to repay the principal along with interest over a certain period. Bonds are typically less erratic than stocks and can offer a consistent income source, making them a worthy contributor to a diversified portfolio. You might consider investing about 15% in government or corporate bonds. Next, we present real estate investment trusts, or REITs. These are firms that own or finance income-generating real estate. By investing in REITs, you gain access to the real estate market without the necessity to purchase or manage properties yourself. REITs frequently pay dividends, rendering them a stable income source. You might assign around 15% to REITs. Lastly, we examine dividend stocks. These are stocks in companies that routinely pay dividends. The dividends can be reinvested to acquire more shares, contributing to long-term wealth accumulation. Seek companies with a history of not merely paying, but progressively increasing dividends over time. You might allocate the remaining 10% to dividend stocks. To recap, our diversified portfolio is 40% in index funds for broad market exposure, 20% in blue-chip stocks for stability and dividends, 15% in bonds for a steady income, 15% in REITs for real estate exposure, and 10% in stocks for long-term wealth accumulation. The focus of this strategy is on persistent growth and stability. It's not about immediate riches, but about gradually building wealth over time. Remember to manage your investments, much like a gardener tends to their plants. This means rebalancing your portfolio regularly to preserve your preferred asset allocation. If one investment excels exceptionally, it may outgrow its intended portion of your portfolio. In such instances, you'd sell some of it and purchase more of your other investments to revert to original allocation. Investing can resemble sailing. You cannot control the wind, but you can adjust your sails. Similarly, you can't control the markets, but you can manage your investment strategy. By adopting a lower-risk, longer-term strategy like this one, you're preparing for a steady course towards financial growth. Remember, gradual growth and stability are key. Regular rebalancing of your portfolio to maintain your desired asset allocation is crucial. Now, let's delve into a higher-risk, short-term investment strategy. We start with the digital currency revolution. Cryptocurrencies like Bitcoin, Ethereum, Ripple, and countless others are making waves in the financial world, offering the potential for rapid returns due to their significant price fluctuations. These can be volatile, so careful research and risk management are essential, but they can be a profitable venture. Consider dedicating a certain portion of your investment in this area. Next, we look at individual growth stocks. These are shares in companies expected to grow at an above-average rate compared to other market entities. High growth potential stocks, especially in emerging industries, can provide substantial returns. Watch recent initial public offerings or companies with breakthrough technologies that could see rapid value appreciation. Allocate a portion of your funds here. Our third point is options trading, which is more speculative. Options are contracts that give you the right, but not the obligation, to buy or sell an asset at a specified price before a set date. They amplify returns by leveraging your investment, but also carry higher risk. Thus, thorough research and understanding are crucial. Consider investing a portion of your funds in options. Fourth on our list are short-term trading strategies, such as day trading or swing trading. This involves buying and selling assets within short time frames to capitalize on market volatility. It requires active monitoring and a good understanding of market trends. To succeed, you must be on top of your game. It's not uncommon for traders to dedicate a portion of their investment capital to these strategies. Lastly, focus on initial coin offerings, or ICOs, and pre-IPO investments. ICOs involve a company selling tokens of a new cryptocurrency before it hits the market, while pre-IPO investments involve buying a stake in a company before it goes public. Both options carry higher risk and are often speculative. However, if the projects succeed or the companies go public successfully, the returns can be substantial. Consider allocating a portion of your investment here. As we conclude, remember this approach is speculative and geared towards capitalizing on short-term market movements. It carries higher potential returns and higher risks. Stay informed, set clear exit strategies, and be prepared for the possibility of losses. This isn't a strategy for everyone, but if you're open to more risk and seeking potentially higher returns, it could be a good fit. Remember, this approach carries higher risks along with the potential for higher returns. Always stay informed, set clear exit strategies, and be prepared for the possibility of losses. So there you have it, 2 distinct approaches to investment. We've journeyed through the realm of investments, exploring both lower risk, longer-term strategies, and higher risk, short-term alternatives. It's essential to remember that these are not the only paths available, but they offer a solid foundation from which to build your investment strategy. In the realm of lower risk, longer-term investments, we started with index funds, which offer a diversified exposure to a variety of stocks, cushioning you from the volatility of individual companies. We then moved on to blue-chip stocks, the stalwarts of the market that often provide dividends, followed by bonds, which are generally less volatile and provide a steady stream of income. Real estate investment trusts, or REITs, afford you a taste of the property market without the hassle, and dividend stocks offer the potential for long-term wealth accumulation. This approach emphasizes steady growth and stability, aligning with a more conservative, low-risk investment strategy. Conversely, for those with an appetite for higher risk in exchange for potentially higher returns, we discussed options like cryptocurrencies, individual growth stocks, options trading, short-term trading strategies, and initial coin offerings or pre-IPO investments. These strategies are more speculative and require active monitoring, thorough research, and a clear understanding of market trends. They're not for the faint-hearted, but for those willing to embrace the risk. The rewards can be substantial. But regardless of the path you choose, it's crucial to align your investment strategy with your personal financial goals and risk tolerance. Investing isn't a one-size-fits-all journey. It's a tailored suit designed to fit you and your financial aspirations perfectly. Before you take the plunge, do your homework. Read widely, ask questions, and consider seeking advice from a financial advisor. Knowledge is your best ally in the world of investing. Remember, investing is a journey, not a destination. Make informed decisions, stay patient, and allow your investments to grow. Good luck with your investment journey.